Over the last 28 years that I've been in business, one of the things that I consistently find is that people are paying way more for owning their mutual funds than what they think they're paying. And this originally hit me probably about 8 years into the profession when I had a mutual fund wholesaler that was asking me what I look at when I'm recommending mutual funds for clients. And I said the name of a fund company that I really liked, and I talked about their expense ratio being reasonable for what they delivered, in my opinion. And he had stated to me that the expense ratio doesn't tell the whole story of the cost that mutual fund owners are paying. And essentially that sent me down some pretty deep rabbit holes trying to figure out what he meant and what the different costs associated with mutual fund ownership actually is. And so today I'm going to do my best to uncover what mutual funds really cost you in your retirement so you can make more educated decisions going forward in the future. So what we'll cover, we're going to be going over quantifiable costs and actionable takeaways. And the quantifiable costs associated with mutual fund ownership include the expense ratio, transaction costs, cash drag, and tax costs. And we're going to be going over each of those individually, starting with the expense ratio. Now, if you look at the expense ratio associated with actively managed mutual funds, what I believe happens is most people believe, and by most people, I would say close to 99% of the people that I meet with think that the only cost that they have to pay for owning a mutual fund is something called the expense ratio. Now, the expense ratio is usually converted into a percentage, and you can find the expense ratio in those little booklets they give you called prospectuses. And it's those costs associated with the expense ratio are typically used to pay things like marketing costs, distribution costs, and management fees. The average cost on an annual basis of an actively managed mutual fund, according to Morningstar, is 0.59% per year. So on a $100,000 investment at 0.59%, that would be $590 per year. If you want to find out if you're going to do some research and in a quick order want to find out what different mutual fund expense ratios are at, I really like using Yahoo Finance, which has a ton of information regarding a ton of different mutual funds. And for simplicity, I just took a screenshot that I found of one mutual fund called the Oberweis Small Cap Opportunities Fund. And if the screenshot I took is right from Yahoo Finance, you can see for this particular mutual fund, the annual expense ratio was 1.25%. So that's a quick way to find out from Yahoo Finance what the expense ratio is of a mutual fund you might be interested in, or if you already own a mutual fund and you want to find out what it costs, that's a good place to go to discover it. What is much more difficult to find is something called transaction costs. And when a mutual fund manager is buying and selling stocks in a brokerage account, it creates brokerage commissions, and those are not included in the expense ratio. You can find what brokerage commissions are inside of something called a statement of additional information. This is separate from your prospectus. You either have to request it from the fund company that you want to do business with, or you can frequently find statement of additional information. You can find that information online as well. But it's going to tell you part of the story. It's going to tell you what the brokerage commissions are associated with that mutual fund. But there are reasons why it's only telling you part of the story, which I'll get into in just a little bit here. But when I wanted to try to quantify what this cost a mutual fund investor on an annual basis, I had to look up online a whole bunch of different research that other people have done on this topic before. And the other people have done their best to quantify the totality of what these transaction cost a mutual fund investor on an annual basis. And there aren't a lot of studies on this, and there are no recent studies that I've been able to find. The most recent study that I felt was credible found that the average annual cost of all these transactions are about 0.75% per year. So on a $100,000 investment at 0.75%, that would cost a mutual fund investor an additional $750 above and beyond their annual expense ratio. Even though it's very difficult to quantify the totality of transaction costs on an annual basis, you can do your own research to kind of get a general idea on what those costs might be. And a few things that are very important to know is, number one, there's something called turnover with a mutual fund. Turnover means it's usually a percentage. So if a mutual fund has a 61% turnover, it means about 61% of the holdings or stocks within the mutual fund are being bought and sold on an annual basis. The more turnover a mutual fund has, the higher the costs generally are. In addition to that, small company mutual funds or small cap mutual funds that invest in smaller company stocks and international mutual funds that invest in international stocks, just by the nature of the platforms they trade on and other inherent costs associated with trading those stocks versus large company stocks or bonds and bond mutual funds, small cap and international stock funds tend to have higher costs associated with a similar level of turnover ratio when compared with large cap funds and bond funds. So more turnover tends to lead to higher costs. Small cap mutual funds and international mutual funds with a similar level of turnover tend to have higher costs than their large cap mutual fund and bond mutual fund counterparts. But if you want to find out what the turnover is of a mutual fund, again, I use the Oberweis Small Cap Opportunities Fund. And again, I went to Yahoo Finance and found that it had a 61% turnover, which isn't that bad for an actively managed mutual fund. You'll see some of them that have well over 100% in annual turnover when you go and do this research. So when you get those higher numbers, that typically means higher costs on top of the expense ratio of the mutual fund that you're buying. So again, if you want to find out only what the brokerage commissions are associated with the mutual fund that you're buying, you have to get something called a statement of additional information, which you can usually find with a simple Google search. But those brokerage commissions, remember, that is not included in the expense ratio. It's in addition to the expense ratio, and it does exclude other transaction costs like things like market impact costs and spread costs and soft dollar costs. Those are costs that are very difficult, if not impossible, to quantify on an ongoing basis. But if your turnover is higher and it's a small cap or an international mutual fund, you can be relatively confident that the costs associated with that mutual fund are going to be high as well. In addition to the expense ratio, and in addition to those transaction costs, there's something called cash drag. Now, cash is frequently held by mutual fund managers to help facilitate liquidity for potential transactions. So if you think about what goes on at a mutual fund on a daily basis, every day that mutual fund company is taking orders to sell certain mutual funds and buy different ones, or to give people their money back. And to help facilitate that without having to constantly be selling securities within the mutual fund, many mutual fund companies will just put a chunk of money in cash. And the bad thing with that cash, especially in a really good year in the markets like we're having so far this year, is you're probably making about this much on the cash relative to the stocks that are growing quite well in a year like this year. Now, it could work the opposite way. In a bad year, having higher cash can be a good thing because it won't go down when the stock market goes down. But having said that, on average, the market goes up 7 out of 10 years. So a study that I cited for cash drag and what the average cost of this costs the average mutual fund investor on an annual basis is about 0.26% per year. So on a $100,000 investment times 0.26% 8%, that's $260 per year in cash drag costs. If you want to get a general idea on how much cash your mutual fund is holding, or if you're looking at investing in a mutual fund, you can find this again on Yahoo Finance, and it'll tell you how much cash a mutual fund has at a given moment in time. I would say anything less than 1% is a pretty low cash drag. Anything higher than that is in my opinion, a higher amount than what I'm comfortable using. Now, in addition to all the different costs that I've already explained, if you own a mutual fund outside of an IRA or a Roth IRA or a 401k or a 403b for that matter, you'll have tax costs associated with the mutual funds that you hold. And the reason that happens is when you buy into a mutual fund, that mutual fund manager probably owns a whole bunch of stocks in it if you're buying a stock mutual fund, and some of those stocks have appreciated in value. And when that mutual fund manager sells those highly appreciated stocks, that creates something called capital gains tax, and that capital gains tax is shared by everybody that owns the mutual fund at that moment in time. And so the average tax cost, according to Morningstar, is about 1.9% per year for an upper income investor. So when you look at the total cost that we've just described, if you have a retirement account and the average expense ratio is about 0.59% per year, if we assume the 0.75% in average transaction costs from the research I cited and the 0.26% in the research I cited, the total cost of owning an actively managed mutual fund is about 1.6% per year. Now, if you own that mutual fund in a taxable account outside of IRAs and Roth IRAs and 401ks, well, now you've got all the same costs that are listed up here, plus you have the tax costs, which are robbing you of annual returns of about 3.49% on average using all the different research that I cited. And so that's why it is so important to make sure that you're closely analyzing the costs of your mutual funds, because there are many mutual funds that have costs that are significantly less than what I just shared with you here. So the actionable takeaways that I would encourage you to do is try to get a better understanding of the costs of the mutual funds that you own by learning to use Yahoo Finance, which is free. You can also learn more about the transaction costs, specifically with the brokerage commissions, by using the statement of additional information. You can also use Morningstar, has a bunch of free resources that are available. All three of these places should be able to help you get a better understanding of the true costs of the mutual funds that you own. And the reason I think this is so important, and the purpose of going through this entire video with you, is, in my opinion, if you look at past performance of actively managed mutual funds and look at the ones that were in the top 25% in the previous 5 years, and then look at how they did over the successive 5 years for all the years that are cited here, you can see that on average of the top quartile actively managed funds, anywhere from 19% to, at the high point, 27% will persist in top performance in the top quartile the next 5 years. So the reason I'm sharing this with you is, if you look at all these mutual funds that do well 1 5-year period and are hoping that that will continue, there's about somewhere in the neighborhood of a 75% chance that that won't happen. In my opinion, the things that you can control that are most predictive of future performance are 2 things. Number 1, controlling unnecessary taxes, and number 2, controlling unnecessary expenses associated with mutual fund ownership. I really appreciate the time you spent with me today. I hope you learned a lot. If you want to talk with one of our advisors that's knowledgeable on these different things, we have a number of certified financial planners at our firm that are specialized in helping people minimize unnecessary costs and get the most out of their retirement investments. You can set up a virtual meeting online or you can and you can schedule a quick 15-minute call at bernicke.com, and we'd love to help you out. So thank you very much for your time today.